One company that has outperformed the market by a large amount over the past year is Aflac, stock ticker AFL, currently trading at $61.88 per share. We can see over the past year they're up 12.2%, and year to date this is a company that is up 6.2%. Now, as a value dividend investor, something I always want to look for is dividend growth over time. And if we look at this chart, we can see that's exactly what you're getting with this company. Anytime you see a dividend growth chart that looks like this, that's a sign of an extremely healthy company. If we scroll up a little bit, we can see this is a company that's had 39 years of consecutive dividend payments and 39 years of dividend growth, making them a dividend aristocrat and getting closer to being a dividend king. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if this is a company we should be buying or selling by calculating its intrinsic value. And on this spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, we have a multiples valuation, and lastly, a dividend discount model. So let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and we're going to plug in their stock ticker. And once I hit enter, you can see all of this data is going to automatically load in. Now we're currently looking at a 365-day change chart. But let's go ahead and zoom out. Let's say we want to look at a 1,000-day change and hit enter. You can kind of see the price fluctuations here. We had a huge drop here in 2020, but since then it's been pretty much trending upwards. If we come over here and look at the dividend data, we can see they're paying out $1.60 per share, giving them a pretty solid starting dividend yield for such a safe company at 2.6%, with a payout ratio at 21.9%. That is a really great sign for this company. With all the dividend growth they've had, still have a low payout ratio. We can see this company is in financials, and analysts currently have a target price of $62. So according to analysts, this is a company that's pretty much fairly valued. But let's go ahead and see if that's true by jumping into our first valuation. That's going to be Graham's valuation. This is a valuation model invented by Benjamin Graham, the author of The Intelligent Investor and one of Warren Buffett's mentors. And here's the formula he laid out for us to calculate intrinsic value. So the first thing we need is our earnings per share, which is plugged in right here. We then multiply by 7, which is the price to earnings of a company with no growth. And then we apply our growth rate projection. Now the growth rate projections for this company are somewhat low. As we can see, we're just applying 2 for our growth rate projection, but then we multiply that by 4.4, which is the average yield of AAA corporate bonds. Once we've done all that, we divide by Y, which is the current yield of AAA corporate bonds, which is sitting somewhat higher than it has been over the past few years. After we do all of this, we come to an intrinsic value of $65 per share, which is a little bit higher than that current trading price. But let's go ahead and look at our discounted cash flow model. And this is one of the most popular ways to value a company. But essentially, what we want to do is we want to apply a growth rate to the future free cash flows of the company. So in order to do this, we plug in the historical free cash flows you can see right here, and this allows us to see the year-over-year growth rate. So it's been a little bit slow over the past few years at 2.3%, negative 1.8, negative 9, 9%, and then we had a little bit of a drawback recently at negative 15.2. And after doing more research into this industry and into Aflac in general, I'm actually applying a negative growth rate to the future free cash flows of the company. That is not something that you typically want to see. It's not a huge negative growth rate, but I am applying a negative 1% growth rate. So after applying that to the future free cash flows of the company and to the terminal value, I found the present value of all of those future free cash flows and added them together here. I then took the company's cash and cash equivalents and then subtracted their total debt to find their equity value. Once I had the equity value, we divide by the number of shares outstanding to come to a discounted cash flow price per share of $97.50, which is way higher than the current trading price of the company. Now I have to say, this is one of the first times that I've ever seen where we apply a negative growth rate to the future free cash flows of this company and still come up with an intrinsic value quite a bit higher than the current price. So this means the historical free cash flow for this company is already extremely strong. But let's go ahead and jump into our multiples valuation model now. And the idea behind our multiples valuation is we should be able to value this company using a multiple such as the price to earnings multiple, and taking companies that are similar in structure to Aflac and seeing how the market is valuing them. So we're taking other financial companies / insurance company, we're taking their stock price and dividing by the earnings per share to find their price to earnings multiple. We then take the average price to earnings multiple, which we can see is 12.11, and multiply by Aflac's earnings per share to come to their intrinsic value at $80.33 per share. So this is higher than their current trading price. So if we jump over and look at the stock screener and look at Aflac's price to earnings multiple, we can see 9.33, so it is lower than the average price to earnings multiple than the other companies that are similar to them. So let's go ahead and jump over to our last valuation, which is going to be our dividend discount model here. And the idea behind our dividend discount models, we should be able to value a company based on how much they pay in dividends and how much that dividend is increasing year over year. So I plugged in the quarterly dividend payouts here so we can see how much this company is paying out every single year. This allows us to see the year over year growth rates, 3.85, 3.7, and then two massive years right here at 17.8 and 21.21. So if you already own this company before these dividend increases, that is a huge win for you as an investor. This is what you absolutely love to see as a dividend growth investor, but that gives them an average growth rate over the past few years of 11.65%. Now moving forward, it probably won't be quite as high as this, but I'm still projecting a pretty high dividend growth rate over time at 5.5%. Now after applying a discount rate of 8%, we come to a dividend discount model price per share of $67.52. Now anytime you do apply a dividend growth rate that is somewhat high, there's two things you want to check. One is going to be the payout ratio, and the second is going to be growing free cash flow. So let's go ahead and check the first one first, and that's going to be our payout ratio. If we jump over to our stock screener, look here, we can see a very, very safe payout ratio at 21.9%. Now we also want to look for growing free cash flow, and if you'll remember, we actually applied a negative growth rate to the future free cash flow for this company. So that is a little bit of a red flag at first, but if you jump back over to our stock screener, again, like we just mentioned, the payout ratio is so long, the dividend increases are going to be sustainable for a very long time, which really means that the negative free cash flow growth rate is not as much of a red flag as you might think. They're still going to have plenty of room to grow their dividends over time for a very long time. But let's go ahead and jump into our output tab. This is where we're going to see all four of our valuations. You can see Grams at 65, multiples at 80, discounted cash flow at 97.5, and dividend discount model at 67.52. So we actually have all four valuations showing a higher intrinsic value than the current price. But when we average all four of them together, we come to an intrinsic value of $77.75. Now, as a value dividend investor, we do always want to apply a margin of safety. So let's say I want to apply a 10% margin of safety. Based off of this, our stock valuation spreadsheet is telling us our acceptable buy price is $69.97 per share, meaning this is a good time to buy the company. Now, for a little bit safer with our investments, let's say we want to apply a 30% margin of safety. Based off of this, our acceptable buy price would be $54.42 per share, meaning now would not be the time to be buying this stock. But go ahead and let me know what you think of this company in the comments down below. As for me, I'm going to keep them on my watch list. I'm going to look into them a little bit more to see if it's a stock I should consider adding to my dividend portfolio. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.